Welcome to Talk Tickers, your deep dive into the insights hidden within the latest earnings calls. Today, we are focusing on Sify Technologies, that's ticker SIFY, SIFY, and their Q2 fiscal year 2026 results, which just came out on October 27, 2025.
Yeah, and the information we have here, it really sets up kind of a classic narrative for anyone watching these big infrastructure plays in emerging markets. You've got this fundamental conflict, right? Sify is making this massive multi-year bet on India's AI and data center boom, this whole super cycle idea. But that long-term vision, it's bumping right up against, well, pressure on their near-term operating performance. So for investors tracking this, the question is really all about timing.
Okay, so our mission today is to cut through that conflict for you. We'll summarize those pretty contrasted financials. We'll definitely analyze the company's aggressive long-term infrastructure strategy, and then we'll try to figure out why the market reacted, frankly, so poorly to what looked like a pretty impressive profitability number. Let's jump straight into that financial snapshot then, because this is really where the split personality of Sify shows up. What was the top line story for the quarter?
Well, the results were definitely mixed. You can see that major investment cycle showing through. Revenue came in at $10,533 million. Now, that translates to a pretty modest 3% increase year over year, just 3%, compared to $10,275 million the year before.
So yeah, if you're a growth investor, that 3% number is probably what's giving you pause.
Right. But okay, if they kind of hit the brakes on sales growth, it looks like they floored the engine on efficiency because those profitability metrics are looking pretty strong. Exactly. That profitability number, the EBITDA, was the clear operational highlight. EBITDA, that's earnings before interest, taxes, depreciation, and amortization, it was $2,361 million. That's a strong 20% jump year over year. So it shows they're getting real operational leverage from their core segments, their existing assets. Basically, they've built the machine, and now they're finding ways to run it more efficiently.
But then there's the headline net loss, which keeps reminding everyone that this efficiency isn't quite hitting the final bottom line yet. They reported an IFRS net loss of $275 million. So for maybe folks less familiar, what does that IFRS net loss actually tell us about the cost of this big growth strategy?
It tells you they're accounting for enormous investment right now. IFRS, that's International Financial Reporting Standards. Reporting a net loss under IFRS, it signals that the sort of accounting costs of this build cycle are hitting the net income immediately. And that's mainly down to elevated D&A depreciation, amortization, and also rising interest costs from funding all this.
Got it. So if they're building, say, $100 million worth of new data centers, they have to start depreciating those assets on the books right away, even if those centers aren't full or generating max revenue yet. And that depreciation drives the reported net loss.
Precisely. They're spending aggressively, taking on debt to build out that 130 megawatts of data center capacity they have online now. And if they keep investing heavily, which they say they plan to, that net loss situation could actually structurally get worse before it gets better. I mean, before the revenues from those new data centers really ramp up enough to offset those costs. It's a classic spend now, profit later situation, but yeah, with some significant short-term accounting bane.
Okay, so how did the market take this conflicted picture? You know, the strong EBITDA versus the soft 3% sales and the net loss.
Well, the market definitely chose to focus on that soft 3% sales number. The immediate reaction was pretty bearish. Shares closed down 1.70% at $12.11. But reports noted much sharper selling midday. I think it dipped, as low as 9% at one point? Yeah. Clearly, the market was looking for that inflection point in sales growth to justify the big run-up in the stock price. And, well, that inflection just wasn't visible this quarter.
Right. Let's unpack the strategic foundation for this growth thesis then. Sify is really positioning itself as an infrastructure powerhouse for India. What does the segment revenue breakdown tell us about where their focus really lies?
Yeah, the segment mix lines up perfectly with that infrastructure story. Network services are 41%, data center services are 39%. So combined, that's 80% of the business? And then digital services make up the remaining 20%. Management keeps talking about Sify being a crucial infrastructure enabler for what they call the AI-led economy in India. That's the pitch.
And the absolute centerpiece of that AI infrastructure has to be the data center build-out, right? We know this requires, like you said, eye-watering CapEx. Can you walk us through the scale of what they're building?
Oh, it's massive. Their total design capacity stands 188 megawatts. That's the target. And crucially, 130 megawatts of that capacity is already built and operational. In Q2, they actually sold an additional 3 megawatts of capacity. Sounded like it was mainly a smaller enterprise deal, not a hyperscaler this time. And to put the capital outlay in perspective, their CapEx for just this single quarter was a staggering 3,064 million.
3 billion rupees. That kind of spend is only justifiable if the returns are really stellar. Management's been talking about typical data center internal rates of return, the IRRs, in the late 20% range. That sounds incredibly aggressive, doesn't it? Are we seeing evidence yet that justifies that kind of confidence, or is this still mostly a projection based on, say, future hyperscale contracts they expect to land?
It's definitely a bold projection, and it's one the market needs to watch very closely. Hitting a late 20s IRR assumes really high utilization rates, probably with those premium hyperscale clients, the big cloud providers, and also a stable pricing environment. Now, the strong 20% EBITDA growth we saw this quarter shows they're excellent at managing the operations of their existing assets efficiently. That's a plus. But that lack of a big revenue jump, that 3% top-line figure, it suggests the ramp-up time for the new 130 millibu might be, maybe longer than the market initially hoped. They're betting big that AI demand will soon just soak up all that new capacity, justifying the CapEx. But yeah, the market's still waiting for the hard evidence on the revenue side.
Okay, now here's where the strategy gets, I think, really interesting, maybe even a bit radical. This intentional drag in the digital services segment. This is a 20% segment, and you said it saw revenue degrowth of 30 to 35%, and it's operating at a loss. Why would a company intentionally let a segment bleed like that?
Right. It sounds counterintuitive, but management confirmed this is a conscious structural decision, a strategic overhaul. The digital services business, basically their IT services arm, is shifting post-COVID. They're moving away from older project-based revenue, like doing one-off system integration jobs, and they're moving towards a consumed as a service model. So think managed services, subscription platforms, things optimized for cloud and AI deployment, more recurring revenue focus.
That shift itself sounds necessary, sure. But why the massive immediate loss? Why is it hitting the P&L so hard right now?
It's the classic cost of retooling, essentially. They're making enormous investments today in talent, hiring expensive AI engineers, developers, and in building out new intellectual property, new platforms. That cost, the operating expense or OPEX, hits the profit and loss statement immediately. Right now. That's what's causing the negative numbers we see. The corresponding recurring revenue, the MRR from these new services, that only really starts rolling in maybe 12 or 18 months down the line, sometimes longer. So they are intentionally depressing current profits to build what they call future-ready capabilities. Capabilities they believe will capture higher margins, stickier contracts tomorrow. It's definitely a high-stakes, high-cost move.
And the ultimate goal isn't just to fix digital services in isolation, but to actually use it to make their core data center and network businesses even stronger.
Exactly. That's the integration play. The new IP being developed by the digital team, it's designed specifically to support and enhance the data center and network segments. Management believes this integrated approach is pretty unique in India, allowing them to monetize the full stack network, DC, and the services on top. They expect this will eventually help push margins in the network segment back up towards that 20% plus range as those networks start monetizing all the low latency edge computing demand that AI is generating. In fact, they're even planning, I think, 10 to 12 edge data centers out in tier 2 and tier 3 cities. And for those, that tight network and DC integration is absolutely critical for success. You can't do edge without a strong network.
Okay, so given that eye-watering CapEx, the $3,064 million per quarter, they clearly can't keep funding this massive expansion purely through retained earnings and their existing debt facilities, right? How exactly are they planning to finance building the next 50-plus megawatts of data center capacity?
Yeah, that leads us straight to the really critical financial lever here. The proposed IPO of their data center subsidiary, it's called Sify Infinit Spaces, or SISL, and they're planning to list it on the Indian market. The rationale is purely about accessing capital. The demand forecasts for DC growth in India are just so enormous, they need the depth of the local Indian capital market to fund that kind of build out. International debt might not be enough or might be too expensive.
Right, and the goal here is also partly to unlock value that might be currently trapped inside the parent company structure, right? What people often call a holding company discount. What does that actually mean for you as an investor looking at Sify?
Yeah, that's a key part of it. A holding company discount basically means the market values the parent company, Sify in this case, at less than the sum of its individual parts. So the data center assets, the SISL part, are seen as highly desirable right now. Globally, these assets often trade at a premium valuation multiple, especially with the AI angle. By spinning SISL off and listing it separately, SISL hopes the market will assign that premium valuation directly to SISL. And that, in turn, should make the parent company's remaining stake in SISL look much more valuable on paper, potentially boosting Sify's overall stock price. It crystallizes the value, basically.
Okay, that makes sense. What's the timeline for this IPO, and what's the complication that might be affecting things right now?
Okay, so the draft red herring prospectus, the DRHP, which is the initial filing document, was filed pretty recently on October 17th. The standard approval time by the regulator in India, SEBI, is typically around 3 months. So doing the math, that sets up a clear, potentially powerful near-term catalyst for Sify stock right around early 2026. However, that IPO filing process itself is causing some immediate market turbulence. This is crucial. Management explicitly stated on the call that because they're in this IPO process, they are prohibited by regulations from making numeric forward statements or giving detailed roadmaps for future DC builds. This is the quiet period. And that forced silence, that lack of quantitative guidance, likely contributed significantly to the market's uncertainty and that pullback we saw after the earnings call. Investors just hate an information vacuum.
Yeah, that lack of hard numbers colliding with a soft revenue print this quarter, that's probably a painful mix for investors who've seen the stock run up so much. Let's put this in context. SIY stock before this pullback had run up over 236% in the last year, mostly based on this big vision of India's digital future, right? So what does this post-earnings dip signal about where the market's head is at right now?
It really signals a fundamental shift in focus, I think. The market seems to be moving past just rewarding the pure vision, the big story. Now it's starting to demand execution timing. When does the vision turn into dollars? The divergence is pretty stark. Management is clearly focused on the multi-year AI runway, which in their view totally justifies a huge capex. The market, however, is asking, okay, when does that newly built 130 megawatts actually translate into sales growth that materially beats that modest 3% print we just saw? The focus has definitely shifted from just the size of the opportunity to the demonstrable pace of customer uptake and hitting that revenue inflection point.
Okay, that sets us up perfectly for our This Is Not Financial Advice segment. This is where we pitch a high conviction, maybe slightly outrageous, but plausible trade idea based on the intelligence we've gathered today. And remember, we are analysts providing food for thought, definitely not investment recommendations.
Right. So the current trade setup, as we've discussed, is this interesting collision of timelines and values. You've got the near-term dip, the stock's down 1.78% on the day after earnings, running smack into this massive, structurally sound, long-term infrastructure trend. That's the trend that drove the 236% run-up over the past year. And the key uncertainty, the thing causing the friction right now, is that roughly 3-month regulatory waiting period for clarity on the SISL IPO.
So how do we structure a trade around that specific catalyst, the IPO resolution expected in early 2026, while maybe hedging some of that underlying weakness we just saw in the Q2 top line and the general uncertainty around the holding company structure right now?
Okay, so our trade idea is what you could call a synthetic long strangle on the SISL IPO catalyst. Here's the action. You'd go long Sify stock now around the current price, let's say $12.11. And at the same time, you would simultaneously short a basket of comparable local India networking or telecom peers, or maybe short a suitable India tech ETF if that's easier.
Okay, explain the logic there. Why marry those two specific moves, long Sify, short the peers or the ETF? What did the short leg achieve?
Well, the thinking is this. The weakness we saw this quarter was likely driven by two main factors, probably temporary ones. That holding company discount, which the IPO aims to fix, and the near-term sales softness that clearly disappointed investors looking for faster growth. The pending SISL IPO is this specific designated event designed to immediately unlock the value of those DC assets. That's the real catalyst we're focused on here. So by simultaneously shorting the peers or the broader India tech market exposure, you're essentially trying to hedge out the general market risks, things like macroeconomic shifts in India or local currency fluctuations or just sector sentiment swings. You're trying to isolate the SIY-specific catalyst, which is the value unlock from the IPO.
Right. So you're basically betting that the positive valuation impact from spinning off SISL will be so significant that it'll completely overwhelm any lingering drag from the Q2 numbers in the net loss situation.
Precisely. You're betting that the substantial valuation premium that could be unlocked by that separate listing, which, based on the timeline, should happen roughly 3 months after the DRHP filing, so early 2026, will significantly outweigh the market's current temporary disappointment over the Q2 top line. Now, this is definitely a higher risk bet. Why? Because if that SEBI approval gets delayed significantly beyond the expected 3-month window, then this catalyst timing play kind of falls apart. And if that happens, the narrative could easily shift back to the Q2 top line weakness and the ongoing capex drain, potentially driving the stock lower. So yeah, it's a high stakes timing bet. You're betting on that regulatory timeline playing out as expected, and you're betting on the market assigning that massive valuation premium that India seems to be giving to AI leveraged DC assets right now.
A very compelling bet, focusing on that arbitrage potential and the regulatory timing. Okay, let's wrap this up. To summarize, Sify delivered pretty solid profitability. That EBITDA up 20% was strong. But the top line was definitely soft at just plus 3%, and that sent the stock lower, mostly on execution concerns. The long-term narrative, though, remains very much fixed on India's massive data center and AI expansion opportunity, which Sify plans to finance strategically through this upcoming SISL IPO.
Exactly. And the central issue for you, the listener, really remains: how long can management keep up this level of fiscal discipline, justify that massive capex spend, $3,064 million just this quarter, primarily for future revenue growth, before the market demands more tangible, near-term top-line results? That inflection point when that 130 megawatts they built really starts producing sales growth significantly above that 3% level. That's probably the single most important metric to watch over the next, say, 2 quarters. That's the proof point the market is waiting for.
Excellent point. Thank you for joining us for this deep dive into this Sify Technologies Q2 FY2026 earnings call. We will catch you on the next Talk Tickers.